Hello and welcome back to another segment of the Retirement Essentials. In today's short video, what I want to do is share with you a recent Facebook Live training that I did about the tale of two tax torpedoes. Right, I don't know if you've heard of that term tax torpedo before, but it's extremely important inside of your retirement finances that you do not get tax torpedoed. So the tax torpedo has to do with the taxation rules around your Social Security benefits and the timing in that. I'll share a little bit about the history of Social Security and what to watch out for to make sure that you don't get tax torpedoed. So without further ado, we'll see you in this training. Hello and welcome back to another episode of Brighter Retirement Radio. I'm your host, Devin Peterson, and on today's podcast, we're actually going to be doing a Facebook Live. So I appreciate all of you joining here today. For those of you that are familiar with our podcast, every other week we launch a podcast on iTunes and iHeartRadio and Stitcher. Today, we're going to be doing a Facebook Live, and as we do on every other weeks. So if you already haven't liked our page on Facebook, which is Brighter Retirement Radio, please go over there and like that page, because that's where we're going to be feeding all that content on a bi-weekly basis. Or a bi-monthly basis. So good to see you. Today's episode is actually about the tale of two tax torpedoes. So bear with me. If you follow me on Facebook or a lot of our other social channels or our podcast, you know that you as my audience are what I call a charitable boomer. So those that are 55 to 75, preparing for or well into retirement, that are charitably minded but very conservative and tax conscientious. And that's why I'm going to share this Facebook Live training with you today, because understanding where taxes can come and explode your retirement finances. Obviously, I use that word on purpose because we're talking about the tale of two tax torpedoes. I think it's very important to understand and master your retirement taxes, because honestly, a penny saved is a penny earned. And that goes a long way when it comes to making sure that you can outlive your money and not run out of money. So in today's topic, we're going to talk about your Social Security benefits initially being created as a tax-free supplemental income source. I know I said initially because it's not the case anymore, but it was back in 1940. So in today's Facebook Live, I want to share with you two different tax torpedoes, and that ultimately and unexpectedly allow the IRS to tax your Social Security benefits at a ridiculous rate, mind you. So follow along for me to share that with you. So we're going to talk about these two tax torpedoes, and then I'm going to answer a few of your questions at the end of this Facebook Live. So to give you an overview of these two different tax torpedoes, one of the tax torpedoes actually happens before you fully retire, and then the other one happens yearly while you're in retirement. So early retirement and into retirement. So let me kind of explain. This first tax torpedo that we're going to talk about is what I affectionately call the early benefits tax torpedo. And the reason why it's called the early benefits tax torpedo is it impacts those that are filing for an early Social Security benefit and not quite at their full retirement age. So before I continue on, let me kind of get a brief summary of the Social Security eligibility, just to make sure we're on the same page. The earliest age that you can file for your Social Security is age 62. You can say it, I know that, Devin. That's easy. Your full retirement age is, for most of you, between 66 and 67, depending on your birthday. And then your deferred full retirement age is age 70. So what we're talking about today is before you turn your full retirement age, which is 66 or 67, if you file between 62 and 67, this is where that torpedo actually impacts you. Are we on the same page? Okay, follow me on this one. So the early benefits tax torpedo reduces your monthly Social Security benefit check by $1 for every $2 that you earn over the earned income limit, which for 2020 is $18,240 or $1,520 a month. So if you earn more than $1,520 a month outside with a part-time job, 1099 income or W-2 income, that's when this tax torpedo can come and impact you in a negative way. So let me give you an example. I always love to keep things simple here at Brighter Wealth Academy. Let me give you an example of how this actually plays out. And in this example, Harry, we're going to use Harry as an example. Harry is considering claiming an early retirement benefit this year at the age of 64. Social Security benefits, so the Social Security office calculates that if he does, he'll receive $866 a month, which is 13% less than if he would have waited till his full retirement age of 66. But Harry also intends to continue working part-time with an income that will be $5,000 over the yearly limit for his earned income. If he does claim early benefits and makes that part-time income each month, Harry would lose $1 out of two, which we talked about, $1 of every two from the $5,000 that he earns over the limit. Meaning that if Harry goes out and gets a part-time job and is earning $5,000 more than that limit, remember the limit was about $18,000, $5,000 over that limit for the year, every dollar that he receives from his Social Security, well, he's going to lose $1 that he receives from his Social Security benefit for every two of that $5,000. So $2,500 a year is going to be penalized to Harry. That's the early benefit tax torpedo. $2,500 a year is what he's going to lose by claiming early retirement and continuing to work part-time and earning over that earned income limit. Now, to be fair, once he turns 66, that limit actually goes away and he can earn as much as he wants once he attains his full retirement age. But essentially for Harry in this example, he not only permanently reduces his Social Security benefits by 13%, but also loses $2,500 a year in Social Security income. Now, wow, if you're filing for your early benefits, both of those are impacting you in a significant way. Now, another important point to mention here is the Social Security office is not so smart to be always caught up on Harry's earning and limit. So what they often do is they'll take that full $2,500 out of one or multiple checks until they get that full amount back for the year. For someone that's in their early retirement and expecting that monthly check, that penalty is going to creep up on them and could impact them for several months until the Social Security gets all of their penalty back. So a few planning tips around tax torpedo number one would be, if you must file early and you do still need to work to cover your expenses, you might consider working with an advisor or doing the math yourself, of course, each year to determine the maximum hours that you can work each month to avoid that tax torpedo. As well as if you still need additional income, consider using non-taxable sources like savings or Roth IRA funds to be able to fill that gap, because that early benefits tax torpedo can be a bit of a killer for your retirement finances. Okay, so that's that first tax torpedo, the early benefits tax torpedo. The second tax torpedo that we're going to talk about in today's Facebook Live is called the RMD or pension tax torpedo, because this tax torpedo absolutely affects you after you retire, after you're taking your pension, and after your RMD starts at the age of now 72. So the primary cause of this tax torpedo really is adding additional income into your taxable sources of income. So of course you've been getting your Social Security income, but where the tax torpedo affects you is when all of a sudden you turn on your pension, and that increases that 100% taxable income, or you turn 72 and that additional RMD surprises you and adds to your taxable income. So just like the first tax torpedo, the impact is caused by this additional income within the Social Security rules. And that's why I want to share this with you today, is Social Security income is a very dynamically taxed creature, meaning Social Security was initially or originally created as a non-taxable supplemental income for retirees. However, in 1984 and then in 1993, Congress and Social Security Office added tiers of taxation to your Social Security. I know, bummer, right? That's kind of the reality that we're living in. So because that's an important part of this tax torpedo, let me briefly explain how Social Security taxation works. So what the office does is they make a calculation based off of your overall income that dictates how much of your Social Security benefits is taxable. This is called a provisional income or sometimes combined income that essentially is 1/2 of your Social Security benefit plus all other income sources plus any tax-exempt interest like on municipal bonds. So 1/2 of your Social Security benefit plus all other income sources plus some of your tax-exempt interest. That equals your provisional income. So it's not all of your income, it's just a calculation. So I already feel myself kind of getting into the nerdy jargon of what this means. So let me kind of simplify it. For married filing jointly, if your provisional income is under $32,000, your Social Security is not taxed at all. If it's between $32,000 and $44,000, up to 50% of your Social Security is taxed, and then $44,000 and above, up to 85% of your Social Security benefits are taxed. So let me kind of bring it back and create a simple example of where this RMD or pension tax torpedo can impact you in retirement. So let me create another example for you. So suppose that you and your spouse collect $60,000 in combined Social Security benefits for the year. And then your only other income so far this year was an additional $65,000 of distributions from your IRA. That makes your provisional income $95,000. Even though you had gotten $125,000 of income, the calculation that they use, the provisional income, is only $95,000. At that point, you've not quite reached the 85% cap on the taxability of Social Security. However, if you take $1,000 more of income from your IRA, you might expect to only pay $220 because you're in a 22% tax bracket. Does that make sense? You take an extra $1,000 of income, you're at a 22% bracket on the federal level. So you would think that you would only pay $220 of taxes on that $1,000. However, this is where that tax torpedo really comes at you and hits you hard. Because it's increasing more of your Social Security that's taxed, it actually taxes $850 more of your Social Security. Your tax bill actually goes up from that $220 that you thought it was to $407, meaning that your marginal rate on that $1,000 is 40.7%. You're paying 40% taxes on those dollars that come out of your IRA. And that's ridiculous, especially when you are only anticipating 22%. So a few planning tips on this tax torpedo. Number one would be really the best ways to prevent this tax torpedo is to consider early planning. Using Roth conversions in your retirement to convert your traditional IRA funds to Roth IRA funds, essentially reducing your IRA balances, which reduces your required minimum distribution balances or amounts that will come out at the age of 72. Also, when you file a pension election, if you have a pension, consider looking into the tax impact of taking a lump sum option as opposed to the monthly benefit option. This will enable you to create a tax plan around the lump sum that just might reduce the long-term tax implication on all of your finances. So in summary, the two things that we talked about today in our Facebook Live is the two tax torpedoes, the early benefits tax torpedo and the RMD pension tax torpedo. So I'm so grateful that you joined me inside of this Brighter Retirement Radio podcast. Feel free to respond in the comments below and let me know if you have any specific questions. I would love to dive in and answer some of those for you. So without further ado, we will sign out and see you next week in our Brighter Retirement Radio podcast. Have a good day.